Good morning and welcome to today's webcast, Prepare for the Future, New Technology, New Steps, and more.
Welcome and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And with that, I will turn it over to today's moderator, Gabe Nashon, Partner and National Practice Leader for Financial Institutions at Moss Adams. Gabe?
Hello, everyone. This is Gabe Nashon, Moss Adams Partner and Financial Institutions National Practice Leader, and welcome to our Moss Adams Financial Services webcast series. I'm pleased today to introduce our speaker, which we first heard about through a mutual community financial institution client whom spoke very highly of the work Neocova, his company, was doing for them. Our speaker today is Sultan Meghji. Sultan is co-founder and chief executive officer of Neocova, a financial technology firm headquartered in St. Louis with operations in New York. Neocova offers artificial intelligence, analytics, and other cloud-based systems that enable financial institutions to operate more efficiently, effectively, and securely by removing the stresses of managing complex systems and complicated contracts. Starting his career at the National Center for Supercomputing Applications, where he developed artificial intelligence systems and first-generation internet technologies, he has provided senior business and technology leadership at numerous organizations. Sultan is an entrepreneur, lecturer, and scholar with more than 25 years of experience in technology, international business, and finance. He has served as an advisor to the U.S. Treasury, G7, FDIC, OCC, State Department, Federal Reserve, and the FBI in the areas of cybersecurity, quantum computing, and artificial intelligence. Sultan is a distinguished member of the Bretton Woods Committee, a member of the Forbes Technology Council, and a member of the Missouri Advisory Committee for the U.S. Global Leadership Coalition. I don't think we could have a more timely topic as institutions accelerate their digital strategies, and we have a bank technology company here today that appreciates data security as much as I've seen relative to a majority of the fintechs I come across. So with that, I will now turn it over to Sultan.
Thank you so much for the introduction, Gabe. It's great to be here and great to talk to all of you. It's interesting. I was scanning the news this morning and I saw 4 different news stories that impact exactly what we're going to talk about today. I saw the House Committee on FinTech Lending and the discussion around the OCC charter that they're proposing. I saw the OFAC announcement from Treasury on ransomware payments. There was, of course, continued fallout from FinCEN, and then initial math is showing a fairly intriguing swing from credit to debit payments across this market. So I think we have a lot to talk about. So to prepare for the future, this title I laughed at a little bit because it's not that, this is something that's going to happen 3 or 4 years from now. This is happening right now, and some of the people listening to this are already doing it. So it's exciting to have such a great group of people on it. But I wanted to start by just talking about the state of the industry just a little bit. And I hate reading slides, so I'll just let you guys read this while I talk about this and a few other things. Beyond the numbers that are here, we see the increased competition, the focus on digital, but this overall pace of transformation is just accelerating rapidly. I was talking to a big capital markets guy back in January or February, and his view was, pretty much every bank is going to have to change their core in the next 3 years, which I thought was great because, we're averaging only like a 15% core change, opportunity per year historically. But then you turn around and see that it's not just that that's happening. It's payments infrastructure is changing, regulatory technologies are changing, BSA/AML, and that's going to continue to increase. All of these things happening while at the same time the fundamentals of some of the balance sheets of big parts of this market are rapidly changing. You're seeing branches close, you're seeing more competition from fintechs, you're seeing more competition from the big guys, and it's all causing this market to kind of rumble a little bit. And you see all these ripples. The other kind of interesting thing, and I appreciate Gabe highlighting the cybersecurity piece of this, is we're beginning to see more and more direct evidence between cybersecurity and financial fraud. And the simplest way I can highlight that is going into this year, through some of the work we did at the Carnegie Endowment, we were seeing a model that suggested a 300% increase in attempted fraudulent payments transactions this year before COVID. As of last week, the real numbers are saying the floor of that for this year is going to be a 700% increase. And so it highlights to me the first recommendation that I make in this discussion is to specifically say cybersecurity needs to not just be something that you're talking about at the working level. It needs to go all the way to the board of directors. I recommend your chief information security officer have a dotted line into a designated board member so that this can become part of that discussion, and there's a monthly update and specific activity and funding attached to that. We're seeing such a big swing in that, and I can't go into tremendous detail on this, but we're working with multiple federal regulators to put some of our artificial intelligence inside of their systems to help them not just more cleanly draw that linkage between cybersecurity events in market and fraudulent activities, but then also to push that back out into the banking sector. There is a tremendous increase in this activity. And if you are, like so many community banks in the United States, using the equivalent of a 1972 Pinto to run your back office systems, it's going to be very hard for you to respond to these. So recommendation number one is increase your focus on cybersecurity. The second thing that I always like to highlight here is that, for a lot of people who've been in this market a long time, it was kind of highly distributed in terms of the technical maturity of organizations. And all the last 6 months have done is really broaden that. So some organizations haven't done anything in 15 years, and some are doing a lot on a daily and weekly basis, and that's great, but that gap is growing. And the criminal element, whether it's state-backed or not state-backed, is definitely going down that path. We are seeing such a tremendous set of activities, especially from the People's Republic of China and Russia, targeting the American financial infrastructure. So please be very careful about that. So that's one piece of it. The other thing that I would say is, as we see these evolutions, there's a tremendous opportunity for this industry to continue to do amazing things. I talk to bank CEOs all the time, and I talk to customers of community banks all the time. And there's this huge opportunity for community banks to continue to do what they've done best, which is to bank their communities and to have that personal relationship. And technology should be a huge enabler for that. And so I'd like to highlight that the ability of community banks to use technology to enable them to connect with their customers is very high. So when you think about partnering with fintechs, which is what we're seeing so many effective organizations do, you see two paths. Path number one is to work on your back office, drive efficiency, drive scale of human activity, get your people to be more efficient, get automated processes, use artificial intelligence, etc. And the other one is on the front end in terms of capturing that customer relationship in a stickier way, whether or not it's through mobile or web-based applications or just analytics so that you understand, hey, I have a customer and he only has one of our 20 products. Here are the next 3 he should be targeted towards. In that vein, it's important to note that just this year, we're looking at a 20% increase on average per bank in tech spending. That's incredible. We've never seen anything like that. And what's interesting is you go and you actually look at what they're spending the money on. It's really a broad spectrum of things. It's in the two veins I just described. The back office efficiency gains make up a huge amount of that, where previously the weight was on the front end and everyone was hiring the fintechs, partnering them to do these, a deposit origination or loan origination program. That's great, but that's not really where the real value is. It's the back office is where the value is, and it's the analytics around that. And so we're seeing a lot of activity around real-time analytics of bank performance, real-time BSA and AML and other fraud activities, and then also the ability to integrate data from a variety of different places in real time so that everyone from the chairman to somebody sitting at a teller's desk has a real-time view of what they're supposed to be doing. The one I like, the example I like to give here is where there's a bank in our universe that is going to go public next year, and they are an amazing bank, fantastic organic and inorganic growth. They're really doing everything correctly, and they've done a lot in the last 6 months to really continue to do great stuff, and they've made a lot of good money here. Their CFO, because he's using a legacy core platform, has absolutely no idea what their balance sheet looks like on a day-to-day basis. And, one of their security officers has a big chunk of their data sitting in an Excel spreadsheet on their desk. They are not going to be able to go public with that. And so you see a lot of that spending designed to give real-time intelligence to organizations so they can understand things like bank profitability, customer profitability, get the relationships with their regulators squared away correctly, et cetera. So the next big recommendation that I will say is when you work with fintechs, it's not an if, but when you work with fintechs, look for fintechs that are regulatory forward, that have already gone through the same processes that you guys have. You want a fintech where the leadership of the fintech will sit shoulder to shoulder with you, with your regulatory partners, so that you are guaranteed of they are inherently embedded in your success, which then makes them successful. Coastal Community Bank was one of our first customers, and that's a really fun part of the relationship we have with them, is sitting in front of some of the regulatory partners with them. And I will let Eric and others from that group talk about how amazing that was. It's been a fun series of conversations. The other interesting thing on the technology side is the underlying technologies are becoming so powerful that this historic model of paying tens or hundreds of thousands of dollars in consulting fees and waiting 6, 12, 18, 24 months to get something is fading very quickly. That is vintage technology at this point. There are many organizations out there where you could sign a contract for a piece of technology on a Friday and be using it on a Monday. So your path to value, your time to value is highly compressed. And it's not a 6-figure conversation. It's a spend $50,000 and try out this program and see if it makes your BSA processes more efficient, or it helps your organic depository growth in a much shorter amount of time. And so with your fintech partners, that's another thing to pay attention to, is do they have that capability of bringing value to you immediately, and to have a path to ever increase that value as you become more and more successful. So with that, I think we will go over to the first poll question.
Okay. So the first polling question is, which best describes your institution's tech spend in fiscal year 2020? And your options are A, decreased from fiscal year 2019, B, stayed consistent with fiscal year 2019. C, increased more than 5%. D, increased more than 10%. Or E, increased more than 20%. And we will give you a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. Okay, it looks like most everyone has had a chance to respond. Sultan, back to you with these results.
Oh, these are fascinating. I'm really intrigued to see this. Categories D and E are really fascinating. We're basically talking about 40% of the market have increased their tech spend this year more than any other point in history. That's an amazing number. Thank you all so much for that. That's going to give me something to think about later today. Let's go. I actually would say the only thing I'm surprised at is A, but that's a separate conversation. Anyone who answered A, reach out to me. I'd be really curious as to what's going on there. I hope it means you've signed up with us as a partner, because that's a solution that gets you there. But I'm not sure about anything else. So let's jump over here to some things for organizations to consider right now. And when I talk about programs where you can sign a contract on Friday and get value on Monday, here are 3 direct examples. And number 1 is my favorite, because it's something that doesn't seem interesting. It's kind of not sexy. It's plumbing. But data unification and normalization, which also implies centralization, by the way, is an absolutely fantastic way to give your people significantly more capabilities, because just by doing this, just by getting your data somewhere where you can control it, unlike with most of the core providers out there where you have to pay an extra fee or hand on keyboard something to do anything useful, putting it in a proper data unification platform with a data model, with normalization, so that it keeps itself fresh and you can build against that. It really allows you as a bank to really understand where you are. And that's something that a lot of organizations struggle with. I've talked to a lot of bank CEOs, and they have people who spend all week getting a report ready to look at on Friday afternoon, and then Monday they just go and do it all over again. Wouldn't it be great if on Friday, as a bank CEO or chief lending officer or whatever role you have, you can just log into a web interface and the dashboard is there, the analytics are there, it's able for you to see, and you can see the canned reports, you can see the canned results, but you can also go in and say, hey, this product looks like it's lagging a little bit. Let's dig into that a little bit. And it gives you the ability to really take all of your experience as bankers and apply it in real time. There are a variety of ways you can jump on that, but there are a lot of players out there, including us, where you could sign up for something on day 1 and jump right into doing something. The other thing that allows you to do is to start plugging in to the fintechs, to find fintechs to partner, to find other ways of launching products and services in market, other ways of driving efficiency into your organization. And it decouples you from your traditional core vendor, so that then you can own your own destiny. You can start digging into things. So that is absolutely the first place to start. Number 2 is compliance. I am, kind of not pleasantly shocked sometimes when I see some of these organizations and their compliance processes are just a bunch of people running around. And because of that, their regulatory relationships can become strained. It's just an inefficient way of operating. And the regulators are becoming less and less sympathetic to that, because they see that in the market, there are a tremendous number of opportunities for organizations to just automate that activity. We spend a lot of time looking at call reports, and one of the most interesting things is how manual so many of them are, and how many hand on keyboard errors there can be, and it just institutes friction and noise in the system. That is a huge win for organizations if you can make that automated. And so it's not people doing the work, it's people checking the work. And so that's something that I highlight for managers inside of banks, is to consider any process, any technology, anything you're doing, if it's somebody's hand on keyboard doing something versus it's someone staring at a screen verifying someone, the second has value. The first really doesn't. And you need to be thinking about how to remove people's hand on keyboard activity so that they can go down that path. And this is where, the FinCEN example is rather interesting, right? 80% of reports filed with FinCEN are false positives. Just think if you had an automated system that could remove that, what that means in terms of the human activity in your back office. FinCEN publicly says that, or actually Department of Justice says that about 25% of the financial crimes that FBI looks at come from reports into FinCEN, but that's in the last 20%. It's not the 80% false positives. For a lot of institutions, especially ones that are more business-oriented, especially mid-sized business-oriented, it's not 80% false positive, it's a much higher number. And there's a lot of basic triaging from an automation perspective you can do that gets rid of that. By doing number one and number two together, you've immediately gotten your regulators excited in a positive way about the steps you're taking, and there are a number of institutions that are doing some really great stuff there. The final one is artificial intelligence and machine learning. And, as a computer scientist, I always like to highlight that machine learning is a subset of artificial intelligence. Artificial intelligence is the category, machine learning is a type of artificial intelligence. For the first time ever this year, all the federal regulators have approved artificial intelligence running in real time in banking systems. Last year, before this year, it wasn't allowed. It is now allowed, and the regulatory community the last couple of years has gotten very aggressive about working with companies like ours to get these technologies into market because of the value they create and the efficiencies they create. And the freedom to do that is there, which I don't think has been necessarily advertised as much as it should be. But if you wanted to run a automated AI BSA platform, not only are there solutions for that, but the regulators are fully embracing of it. So much so that the regulatory community is looking at using these exact same technologies for themselves, so that they can look at a different set of data and help them figure out, for example, what the risk profile of the overall market is. It's really fascinating stuff. But we went from 2 years ago talking about this as a hypothetical to last year spending a lot of time working with the regulators, getting them excited, getting them to sign off on it, to it going live this year. And it's there now. And one of the really nice things about it is it's not a premium product. You're not spending millions of dollars a year to do this. There are banks spending 5 figures to get access to some of these technologies. And it makes everybody's lives a lot easier. The one thing that's not listed here, and it's because I covered it on the front end, and I always like to lead with the cybersecurity piece, is that should always be on this list. Your cybersecurity program should be aggressively driven. A couple of things that I say from a cybersecurity perspective that you should be asking your teams are, number one, are all of our technologies encrypted end to end? You're going to get a qualified answer. The short answer is no, and you need to change it to yes. The second one is, do you require best-in-class authentication and authorization technologies? There isn't a single core live, except for one company out there, that actually requires this. So you need to get to that. The third is, are all of your compliance audit processes not just done, not just up to date, but done in an automated way? So the example I'll give you is vendor due diligence. So as a tech vendor to community banks, we obviously have at Neocova a very strong vendor due diligence support function. And we have an automated function. So if you're going to be a customer of ours, we give you a login to a vendor due diligence system, and it keeps track of all of our partners, all our relationships, all of the legal paperwork, everything you might possibly need. There's no process on our side except to give you as a customer the login so that you can look at it. And guess what? It's the exact same thing we give all the federal regulators and the state's regulators so they can keep an eye on this. And it allows us to, with a little bit of setup, but no day-to-day management, to keep our regulatory processes and our vendor due diligence processes fully synchronized. It's an absolutely fantastic tool out there. It's something that's just another cloud service. We didn't invent it, and we've just used it for this in a very straightforward way. But what I'm getting to is, again, getting away from hand on keyboard. Move away from that idea. get it to human verified, not human on keyboard. And if you're going to invest money, focus on those areas. The duct tape types of technology projects that have been pervasive in the tech industry for the last decade or so, we've moved past that. The technologies aren't there anymore. And so as you look to action right now, you could do number 1 in 6 weeks. You could do number 2 in 10 weeks. You could have number 3 live in days in some cases. You do not have to live in this fiction that this is something that has to be glued together specially for you by some high-priced consultant. Let's jump over to, I believe, our next poll question.
Yes, thank you. So our second polling question is your institution currently using AI machine learning technology? And your options are A, yes, B, no, C, no, but we plan to, or D, not sure. And we will leave this up for a few minutes. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Okay, it looks like most have had a chance to respond. And here are the results.
You know, this is interesting. This is about what I expected. I mean, A just makes me so happy. That's just great. Those are the institutions I get excited about. I'm going to make sure that I know each and every one of you. C gets me almost as excited because my sales guys now know who to call. For B, you know, a follow-on or just reach out to me. I'm very curious, what's stopping you? You know, why isn't that part of the discussion? And then D, for not sure, I feel like I just want to say it's a very simple set of equation. It's a very simple equation. You could pay $50,000 a year for some halfway decent AI that automates out 3 $50,000 a year employees. That's the economics of it. That's your ROI. And so for me, that's the thing I would highlight to you guys. Figure out how to make that ROI, that value math work immediately, and you can jump forward and actually start, you know, moving that needle on that. Let's do this. Okay, so, you know, the future is, you know, I'll be super cliched and say the future is now. The left side of this picture with the legacy core, with the, you know, legacy features all wrapped in this very rigid, painful, terrible contracted, idiotic termination fee, super expensive environment. You know, that's how tech operated in the 90s. You know, banking is, you know, a lot of the banking tech out there is kind of mid 2000s, and that's how it operates. And they try every trick in the book to keep you there, because then you are not the master of your future. They are. And so the path that we recommend to people is really a 2-step process. Number 1 is to start taking the really high value capabilities that drive value into your organization, like data unification, like AI for BSA, you know, like deep customer product and market analytics, and bolt them around. And that gets you to that second picture where you are using highly technical pieces of technology wrapped around your core that alleviate the need for you to work with your core vendors to do the things you need to do to be successful. That's step 1. That is value in weeks. A lot of people think that, and have historically thought, and the core vendors have done this, that in order to do anything, you just move from one version of the far left picture to a different version. I moved from FIS's 1982 technology to Fiserv's 1994 technology. That's not how the world works. That's not how tech works. And so that second picture is actually the most powerful one, because by especially starting with data unification and analytics, you now have the ability to use that as your entry point for anything else you want to do. You want a new mobile app? Great. You want to do BSA? Great. You want a special origination system? Great. That can all be done in that middle picture. And it doesn't require you to have a machete and a fight with a core vendor who brings 18, high-priced lawyers to a discussion with you. The other thing that it does, it sets you up for the picture on the right, where you peel away at that onion of insanity. You don't have to do the rip and replace. You just peel away at that until at the end of the day, the core itself simply becomes a database. And it is the place where your transactions live, where your products live, and where your customers live. All of the value out of that is in the things around it, and they're all modular. And so if you say, you know what, I really like Treasury Management System A, but guess what? A new system comes online and it's better, it's faster, it's got better integrations, it's more tailored towards the nuances of your business. Great, bolt that one on and use them both in parallel, right? You can use one stack of technologies and features for your consumers, for your consumer products, and another one for your small business, or another one for your medium-sized business. You can break out commercial real estate in its entirely separate function. We're working with an institution that's building kind of a unique integrated verticalized stack for real estate, and this is exactly the path they're going. And it allows them to just remove that legacy vendor over time with no hair on fire Sunday night activities. It's a wonderful place for banks to be, that far right picture, because you can just unbundle the world from this kind of static monster that's sitting there. And the other part of it is, by going down the path like this, it allows you to handle cybersecurity, it allows you to build in automation, it allows you to use artificial intelligence where necessary. And then if you want to jump into, really advanced technologies, you want to, do IoT, you want to start putting in ITMs in baseball fields, you want to, go down the list of all the really sexy new technologies, you can do that. And so through this process, you have this unbelievable capability of spending small amounts of money, getting large amounts of value in a very low risk environment, and you can act today. This was not true 2 years ago, but this is true today. As you go down this path, 3 years from now, 5 years from now, the best banks in the United States are going to have a couple of things in common. Number one is they aren't going to have one fintech partnership. They're going to have 10. Number two is they will absolutely not be using the legacy cores that I've highlighted here. Those cores are incapable of doing this. The business models of 7-year contracts and all this kind of stuff, it's gone. I like to say, if you have a 150-page MSA, which I'm sure all of you do, ours is 11 pages. We don't even offer a 7-year contract. We started a 1-year contract. There are no termination fees. These are the things that will be absolutely true across the market. We've already seen FIS try to change their business model to fit what we're doing. And the fact is that they can't get there because it would fundamentally change their balance sheet. They can't support that because they're not that efficient of an organization. The other thing that will be true is that people will be able to try out stuff for $10,000 in 3 weeks. And if it works, great, it'll grow. And if it doesn't, they just unplug it and it's a $10,000 investment lost. So the iteration cycle of community banks, the most successful ones, are going to look a lot like what fintechs are doing already today. But it's going to be done inside of the regulatory system. The other thing that we are going to see is that we're going to see, instead of 90 and 120-day batch data cycles with the regulatory community, it's going to be close to real-time data back and forth. And what that's going to allow the best banks to do is to operate with more freedom, with less friction, and with less regulatory burden. And I know that might not sound like something that's possible, but I got to tell you, we're on the inside of a bunch of this. I'm incredibly excited about what's coming over the next few years from some of the regulators in terms of their ability to remove people from conversations, to remove this kind of hands-on technology work. And it's going to make the average community banker's life a lot easier. And we've heard about some of it in the press already. There's a bunch of other really awesome stuff coming I can't talk about, sadly. But the other thing that's going to be true, and this is the one that if anyone wants to take me up on this, I have a feeling I hope I don't owe too many drinks to people. But I think we are going to see much more market specialization in community banking. You're going to see a lot more focus on specific subsets. I think the days of a community bank that offers every single product and feature that every other community bank offers is going to go away pretty quickly. You know, there are already some great community banks out there that are doing, for example, sponsorship functions or just focused on specific small business or commercial real estate or a variety of other areas. And I think we're going to continue to see that. The final thing that is absolutely going to be true, and the first real one of these launches here in about a year, is the ability for a bank to completely outsource their back office. You will be able to sign a contract and say, we are going to have X number of consumer checking accounts, Y number of auto loans, Z number of commercial accounts of this kind and that kind, and we'll pay some nominal dollar amount per month, $1.50, $1.75 per account. And everything behind that will be managed by an outsourced provider that is sitting inside of the regulatory system. That, you know, some people are launching things called banking as a service. They're not really banking as a service. What I just described is the real banking as a service. The first one of those really launches next year, and that will allow organizations to move from paying on average $10 per account per month, all in for technology, to, you know, something like $1 or $2. It will be a radical cost decrease to the back office, and it will radically change how community banks operate. And I have no doubt at all that we'll see hundreds of banks operating like that within about 5 years. So, on to the next poll question.
Okay, the third polling question: how likely is it that your institution will switch core providers when its current contract is up? And your options are A, highly likely, B, somewhat likely, C, not likely, and D, unsure. And for those of you that would like a copy of today's slides, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. If you receive an error, please refresh your browser by hitting F5. And if that does not work, just know that we will be sending out a copy of today's presentation to all attendees. We'll give everyone a few more moments. Okay, Sultan?
It's so interesting. I see 6.7% for highly likely. That is almost exactly the standard number. That's so interesting. The not likely one I'm very surprised at. And I would say to anyone who thinks they're not going to change their core, you know, take your all-in technology spend and drop it by 50%, and that's what you would get as an initial first step. So I'm very excited to see why people are saying not likely. So if you're not likely, drop me a note. I'm very curious why not. That's always a fascinating one. I always love hearing that answer because there's a pretty broad spectrum of them. So to finish what they will look like in 5 years, stepping away from the technology side, here's my pontification and magic 8-ball all rolled into one. And just as an aside for those on this, because I know there are a number of people on here who know me, I usually have this very big beard, and I shaved it as part of a fundraiser for an absolutely amazing pediatric cancer charity called Sebastian Strong. And I won't derail the conversation entirely, but if cancer is something that's meaningful to you, please look up what Sebastian Strong is doing and listen to the story of what Oscar, Rose, and the rest of the Ortiz family went through. But I make the magic 8-ball joke because I am now kind of a big shiny magic 8-ball myself. So let's talk about this. Let's talk about nationally recognized products and services. You know, there are banks already, community banks already, that are offering amazing nationally recognized products and services. Now, they might not be consumer services, but they might be amazing things. I'm waiting for that one community bank to crack the mobile auto loan program, and they come up with that absolutely amazing brand around it that's a nationally recognized product and service, but it's run out of a normal community bank, just like everybody on here listening here. The second thing is that we will see entirely automated, entirely digital automated accounting and operating processes for entire institutions, whether or not they're using banking as a service or not. The days of the accountant being hands-on on the balance sheet is not going to be true anymore. And then the final one is, I've said this already, but I'll reiterate it, innovation cycles that rival fintechs. This, to me, by the way, is you see a marked difference between the organizations that have not yet developed internal change management processes that allow them to execute at pace. But then those, once they do, that's the biggest thing they are going to learn from their fintech partners, is how to act at that pace, how to get that energy and that change management process to work together so that banks can operate at that same pace. If you are a bank and you are partnering with a fintech and you are not fundamentally using that as an opportunity for your people to be trained up on how fintechs aggressively launch things in market, you're missing a huge opportunity. One of the biggest challenges in the economy of the United States right now are people, right? We don't have as many people with the right skills. You know, as someone who runs fundamentally an artificial intelligence company, I spend half my time making sure that we're recruiting the best people and that we build the processes to get them inside, get them indoctrinated, and keep them, right? For community bankers, it's even worse. All of you are struggling with hiring. This is a great motivator for that. Think about the real hotshot 20 and 30-year-olds in your organization, the high potentials. How do you keep them? Get them to be learning from fintechs as part of their day job. We've watched a number of organizations that, in theory, should really struggle with their people, but they're not because of this. And this is a huge opportunity. The thing I would caution, though, is don't create a separate innovation silo. Don't keep it outside of it. Don't create a digital transformation program separate from the rest of the organization. My other big recommendation for the organizational management types is integrate AI, integrate digital transformation, integrate cybersecurity into the operating processes of the organization. Just like you would make diversity core to each department head's annual review, make these the same thing. We also see a direct correlation between organizations that do well on diversity and do well on digital transformation. So if you're doing one okay and the other one not so great, lift the other one up a little bit. There's a huge opportunity there. Okay, so here are the technical steps. Here's the playbook, if you will, or the cookbook, or whatever language you want to do. Okay, so number one is build that internal change management recruiting program today. You will be changing significant parts of your organization in the next 2 or 3 years. We have had a number of institutions come to us ready to sign a contract today, and then we say, okay, and then we go to them and say, okay, here are the things you guys have to be ready to do, and they take it back to their organization, and we don't hear from them for like 3 weeks. And then I called the bank CEO, and I'm like, hey, what's going on? Like, I thought we were ready to go. And he's like, yeah, my people can't move fast enough. My people don't know how to change that. Or we go in and we look at how we handle BSA processes in reality versus what's in the binder, and they're different, and we've got to fix that. So no matter what you do, you're going to have to handle that first one, and that's an internal thing. It has nothing to do with technology. It has to do with building that change state capability into your organization. Second is you have to have that innovation strategy. You have to have that built into the organization. I'm absolutely convinced that we will lose half of all community banks in this country in the next 5 years because of number one and number two not being done properly. The M&A pipeline for this year is fascinating, right? A lot of people haven't figured out how to do due diligence. People are figuring that out, even before the COVID vaccine will be available next year. The ability to really manage that, get that running, and manage through M&A is going to become a big thing because we're still going to see a big compression, and that's not going to go away. We're not going to become Canada with like 6 banks or anything like that. We'll still have thousands, but it won't be, it won't be plateauing. There are also, by the way, I think at last count, 19 de novos in process right now, and a couple of them are aimed right at the community banking space. It's a bunch of guys from a Midwestern state who've been bankers in a Midwestern state for 30 years, and they're just like, you know what, we're just going to do this cleanly from day one. And they're well funded, they've got great teams, they're working with the regulators the right way, and they're not calling it any of the legacy cores. They're calling the new guys because we can actually make this happen. The third is restructure your core contract. I cannot say this strongly enough. Do not wait until you're in that 18-month window before. Get in front of them early and easily. If you don't have the internal horsepower to kind of beat them over the head to get them where you need to go, there are a bunch of great organizations that can support you on that. I'm happy to talk to you or recommend a few people to talk to. But you should be able to, with no effort whatsoever, get to a point with your contract with your core vendor where the two most important things change. Number one, the exclusivity clause is removed. There's a paragraph, find it, red line, just through that entire clause. And there's a right of first refusal clause and a bunch of other stuff built into that. Get that out. That is an idiotic thing. It's anti-competitive. It basically means that you have to go to them before you're allowed to buy any technology. That's silly and idiotic. And that I don't think that necessarily would change at the legislative level, but you can change it at a business negotiation level. The second thing is get to a point where you have a 2-year no termination penalty clause in your contract. Get that done now so that 2 years from now when you do have to make the change, if you haven't already made it, you aren't financially hit very hard by that. Every single core vendor is signing that right now. We're hearing about it from everyone. And so if you're not getting it, you just got to push harder. You'll get there. The other thing that on the core contract to remember is they make their money from the consulting fees, from the network fees, and from licensing 20-year-old technology to you, no matter what fancy wrapper they put around it. That's all going to go away. We have seen vendors in this space evolve quickly, right? There are some that have gone public recently that are going down this path. They're new entrants like us. This is a $60 billion a year market, and there are a lot of people who want a piece of that pie, and they will find ways to make it more financially viable for you to change your core or to change the pieces of the core you are using. The way I frame it is, I'm sure everybody's heard of SpaceX. SpaceX has spent sum total in its entire life less than $6 billion. And now they're on track to, in a few years, go to Mars and a bunch of other stuff, right? They've spent in their entire life less than 10% of what this market spends on technology in 1 year. That will change, and it will change radically. And for all of these companies that are trying to kind of keep it as is and just make it a few years, you've got to be very careful because you're going to run out of runway. So give yourself the freedom in a few years to be able to change and go in the direction you need to go, regardless of where that is. I don't read the future very well, but I will say that I would always prefer to have the optionality of maybe staying with it or maybe not, or maybe getting a discount or not. But we pay attention when companies come to us, and if they just signed a 7-year contract, then there's only a medium amount of value we can bring to them immediately. And if they have the exclusivity clauses and stuff like that. So my biggest recommendation is to do that. There's some great law firms out there. There's some great groups. There are great people that can help you through that. But every single one of the legacy core vendors knows that their backs are against a wall on this, and so they're all dealing. And so if you're hearing that they're not dealing, you just got to push harder. So that's my piece of advice on that. But get that core contract so that 2 years out, you have the freedom to go any way you want. And keep that 2-year freedom. Okay, so let's jump over to the next poll question.
All right, thank you. The last polling question is, has your institution's recruitment of technology-related positions increased in the last 3 years? Your options are A, yes, B, no, or C, unsure. And once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window to the right of the slide view. We'll leave this up here for a few more seconds. Okay, here are the results.
Oh, that's fantastic. That's absolutely fantastic. This is exactly what I want to see for this. Sorry, I'm just trying to answer one question very quickly. I'm trying to multitask. That's great. So just to close off a little bit before we go into the Q&A section, I want you guys to leave this discussion with a couple of things. One is the market is changing rapidly. That change isn't going to go away. It's going to accelerate. It's going to accelerate because of balance sheet challenges. It's going to accelerate because of competition. It's going to accelerate because of regulatory change, and it's going to accelerate because of people like me. So that's number one. Number two is cybersecurity, cybersecurity, cybersecurity. And then regulatory compliance, regulatory compliance, regulatory compliance. That threat level is going up in a way we have not seen in any other market in human history. People are getting hit every day, thousands of times a day, and it takes one small error by one of your legacy core providers or a piece of bad code from 15 years ago to really expose you to a tough situation. And if the OFAC announcement today gives you any inclination, the regulatory community is going to get harder and push more and more on this. We are trying at the policy level to kind of keep them from getting a little crazy, but we're still, we still see that coming. And then the final thing is AI, cloud, all of these advanced technologies we're talking about, unbundled course, all of this, these are not hypotheticals. These are not 3-year in the future, 5-year in the future discussions. These are things you could sign up for this week if you wanted to and add direct value this week if you wanted to. And so I challenge all of you to figure out what your strategy is. I challenge all of you to figure out what your change management program is. And I challenge you to figure out what you can do in the next quarter to really add some value. So with that, I will pause and I think turn it back over to Gabe. Is that right?
Yes, thank you. We've got a few questions here. We've got time for a few questions, and if we're not able to respond to your question within the presentation time frame here, we will get back to you. Since we were talking about contracts here, and I'll try to merge questions also as well, and you've talked about the core provider, and we've got a question in terms of whether Neocova restricts third-party fintechs and how that works, and will you allow API integrations such as ID&V or identity and verification, which seems to be where things break down a little bit in terms of working with a fintech and trying to get to that level that's expected. And so could you speak to that question?
Yeah, absolutely. I would say two things. Number one is, unlike the legacy core vendors, we don't care. In fact, we know we're not going to build every widget that every bank could conceivably want. And so we built our platform to be an entirely open platform from day one. No matter which technology you buy from us, whether or not it's our underlying platform, Finuron, or the core itself, Ambius, it has an open API at no extra charge that you can access directly. It's that simple. There's no if and or but about it. There's no issue there. And that's because we want the banks to build that far right picture, that new core in that free environment.
Okay, and kind of dovetailing off of that, when you're executing these core conversions, so during a core conversion, does Neocova have a way of de-risking when switching from one core to another?
Yeah, so one of the reasons that we built multiple products in parallel, the core, the analytics, the AI, the regulatory compliance, et cetera, is because they all sit in a common platform. They all sit on a common data model. They all have what we call a single source line. There is no customizations of our technology. There's no consulting. You just sign up for a service, you pay for a utility of it, and that's it. And that allows us to use advanced artificial intelligence to grab data and do the transformation in real time. And so no matter what product you pick, we're doing the data transformation and landing in the normalized structure in real time. And so we actually, in a lot of cases, will recommend organizations start with something other than core, just so that we can get all the data in, get all the data normalization done, get all the partner hooks plugged in if we need to. I mean, we have like 60 partner plus right now, and there are always some that we haven't seen before. But what that allows us to do is de-risk the core conversion by 90+% just before we even get to the actual conversation about the core, because the data is already in the system. It's already cleaned up. It's already organized. And the bank has a very clear understanding of what's going to happen on day one of core transformation, because it's not Sunday night, hair on fire, everyone running around like chickens with their head cut off. It's, okay, we're going to move, payment gateway. We're going to move a couple of, end user interfaces, and that's it. It becomes a much more straightforward conversation.
Good. The next question we've got here is an interesting one to me because I listened intently to everything you said. It seems on the front edge, it's the next thing, where people are going, and then you think about something, all the discussion, although it seems to have calmed down a little bit in terms of, blockchain, but, then that ebbs and flows. I shouldn't say it calmed down, but, a lot of things going on out there that's taking attention away from it. But, I'd like you speak to, how what you're doing isn't, leaving that out. So how do you see this decentralized finance or cryptocurrencies, how, blockchain, how would that affect, not only traditional banking system, because obviously that's going to change, but in terms of integrating with what you're doing, and you're not leaving that piece of this whole puzzle behind either.
No, it's a great question, and I answer it in phases. So first off is I think the notion of any cryptocurrency taking primacy over the U.S. dollar is generations away from even being talked about seriously, because it's a sovereignty issue fundamentally. I can't imagine the United States government giving up control over the U.S. dollar, right? So, or any other country giving up their currency, right? So that's kind of part one. Part two is there aren't a lot of great use cases for blockchain. That's a fundamental problem, especially in banking. There are a lot of use cases that you can make work, but I would argue, what's the value? Like, what's the value in decentralized ownership, right? And there's a big conversation there. We've seen some interesting fintechs do stuff, but that's all ancillary to the core functioning of a community bank. We do not sell blockchain technology. There is no blockchain in our core at all. I don't plan on there being one. We have a partnership with one of the best companies out there that makes enterprise-grade blockchain technologies called Consensus. And the minute the two of us agree on a use case, we'll talk about it. But John and Joe and the guys over there and I talk about this every month or so. And for the bread and butter of community banking in the United States, it doesn't really have a big play there. Now, if you talk about stablecoin and what the Fed is talking about doing and stuff like that, that's kind of a different conversation. All that becomes is just an API into how to move money from point A to point B in a slightly different way. And if the Fed chooses to use that for their infrastructure versus some more stable technology, I think that's still to be decided.
Very good. So let's try to squeeze in one more question. We've got a question here, and I like this one because I liked what you said about finding some of the younger folks within the institution and focusing them on technology-oriented things. So we've got a question: as a young credit analyst, what skills should I focus on to be successful in commercial banking? And before you answer, I mean, my perspective is not analyzing your old financial statements, but and so I'm thinking in terms of this, and maybe things we could help them to push the organization to help them be better too. But so as a young credit analyst, what skills should I focus on to be successful in commercial banking? Thoughts there?
Oh, I love that question. So I'm a professor at Washington University. I actually teach the fintech class and how to build fintech classes and some of the analytic classes in the data sciences program. And this to me is an amazing question because it's the exact right thing to ask. So did I see on the web thing his name's Andrew? Yeah, Andrew needs to send me a LinkedIn request. Andrew, I think there are three things that I would do if I was in your position. Number one is I would learn all the technical skills possible. I would learn, Python or Python, possibly R. I would learn where all the good data sets are. I would become conversant in the ability to do the analysis yourself with as broad a data set as you can get access to, on your laptop right now. So that's number one. Number two is I would go in and look at how credit analysis is done in commercial banking right now, and then look at the research on what people are doing to come up with different ways of doing it. So I actually have a group, a graduate student group this semester that's actually looking at using random forest and a bunch of other machine learning algorithms for exactly this. So it's actually a fantastic question because I've got a research group doing it right now. They only started last week, so I don't really have a clear sense of how far they're going to get. So that's the second one. And the third is learn from every banker who's been in the market for 20 years because they've seen a lot of stuff. And they will have a fundamental ability to add that entirely human component of this to something that you, when you're starting off in your career, will need to have. And that will pay dividends long into the future. So beg, steal, bribe, whatever it takes to have the lunch with the senior guy in your department and let him talk about how it's changed over the last 2 decades. Because we're going to see at least that much change in the next 5 years. And if you can see how it's happened previously, that will be a great indicator as to how the banks will try to move forward. I love that question.
Yeah, I do too. So that's all of the time we have for right now. On behalf of Moss Adams, Sultan, I'd really like to thank you for your time and your expertise that you're able to impart to our audience, and we really appreciate your efforts here today. So I'm going to kick it back over to Amy to close out our session for today.
All right, and yes, thank you, Sultan, for a great presentation today. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy of your certificate will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us. We hope you'll join us again next time.